Hello everybody, this is Jinesh and welcome to the YouTube channel Road to Intelligent Investing, where we talk about all the interesting stuff going on in the financial world, especially the stock markets. So in today's video, we are going to be talking about the current market situation and whether or not we are in some sort of a bubble. Alright, let's start with looking at how the markets are looking currently. Nifty at 15,300 as of 26 May is inching closer towards its all-time high of 15,430, reached on 16 Feb 2021. One of the reasons being the peaking of coronavirus cases and the gradual decrease in them. The rolling out of vaccines is also helping reinforcing the positive outlook towards the demand recovering. But let's address the question of whether we are in some sort of a financial bubble. First, let's understand the different stages of a financial bubble and how they come into beginning. Hyman Minsky, an American economist, laid out 5 stages of a typical credit cycle. First comes displacement. This is when investors start to notice a new paradigm, like a new product or technology or historically low interest rates, as is in the case of our current situation. Next comes a boom. Prices start to rise. Then they gain even more momentum when newer and newer investors start to participate in the markets. There is a sense of fear of missing out, causing even more people to start buying assets. Then comes euphoria. When euphoria hits the market, the caution exercised by retail investors before buying any asset is virtually thrown out of the window. People start to feel nothing can remotely go wrong and are habituated to the fast profit scheme. Once the euphoria starts to fade and some caution is injected, profit taking begins. This is a phase when people are typically trying to figure out whether they are in some sort of a bubble and are indecisive. A difference of opinion is witnessed and the profit taking is marginally starting in this phase. The profit taking then makes way for panic. The panic is very visible as the market starts to dip faster than it rose. Investors start to sell their assets or their holdings at any price the market is offering them. Share prices decline massively as supply outshines the demand. We started this cycle with the panic phase when the market dipped about 30% in March 2020 on the onset of coronavirus pandemic and nationwide lockdowns. Then came the displacement phase when the interest rates were cut significantly and there was a huge liquidity waiting to be poured back into the financial markets. The market made a bottom at about 8,000 and the boom started as more and more new investors started to join the market to make quick profits while they were sitting locked down in their homes. FII's inflows led to a sharp V-shaped recovery in the market and markets started to make new all-time highs every day. After the all-time high of 15,430 made on 16 February 2021, caution started to creep in as the fears of the second wave of coronavirus started to float in the news. Although the second wave was more fierce and destructive than the first one, there was no meaningful correction in the market whatsoever when compared to the correction we witnessed in March 2020. At present, we lie somewhere in the profit taking or consolidation phase. The road ahead is clearly uncertain. Here is a chart of what happened historically after major bubbles in the stock markets burst. This is a chart of what is called the Buffett's ratio, which is basically the ratio of Wilshire 5000, a benchmark index in the US, to the GDP ratio of the United States. As you can see, whenever the prices started to move ahead of the actual earning growth, the markets were deemed to be called out as a bubble and sharp correction followed. We are sitting on yet another top. To summarize, I do think the markets are overvalued and inflated, but I do not think any dramatic correction like we have seen in the March 2020 of about 30% is coming. Since we have earnings growth and there is a pent-up demand, improved supply chains for almost all the companies, and the reduction of other costs. One cannot, however, deny a correction of about 15 to 20% from the current levels, as these valuations and demand levels are non-sustainable in the longer run. That's it for now, guys. Until next time.